Ladies and gentlemen, from Formula One, Formula Drift, and a rider herself, please welcome to the Dealer Evolution stage, Lorette Nickel.
Hello, everyone. How are we today? So excited that you're here, and welcome to our opening keynote, Full Throttle Analytics and AI. This is a data-driven look back at 2025 and a forward-leaning forecast for 2026. This is powered by advanced analytics and artificial intelligence. And this is where it gets exciting, because today you'll see the debut of a new AI-powered insights engine built specifically for the powersports industry, designed to turn data into faster, smarter, and more strategic decisions. So please welcome to the stage the Dealer Evolution stage from Competitive Analytics, CEO and founder, David Savlowitz, Director of Analytics, Michael Ponton, and Director of AI, Dominic Slauson.
Thank you.
Thank you.
Hello, test, 1, 2. Can you guys hear me? Awesome. Welcome. I'm David Savlowitz. First of all, gigantic thanks to Christy, Cinnamon, Buckner, Lee, Nicole, Alex, Diana, and MIC Research. Without them, their support has been phenomenal. So we have a lot to go over in an hour and 15 minutes. We're going to try to do a 15-minute Q&A as well. But last year I started with a story. But this year, other than retelling the story of the Phoenix, we have a new story that everyone is talking about. This is going to be a metaphor. The first technology that truly terrified humanity was not gunpowder, electricity, the motorcycle, the atom, nor the internet. It's fire. And I'm going to tell you a story, a mythology of Prometheus and fire. But it's not just a story. It's also a metaphor about dire warnings about today's view of AI, yet paradigm-shifting opportunities that are exactly contextual to your business. Let's begin. A distant realm where immense power is kept out of reach. Fire contained, glowing but distant and powerful. Unreachable. Power exists before permission. AI already exists. The question isn't if, it's who controls the access. Prometheus, standing at the edge of the divine realm, watching the fire, curiosity, resolve, and defiance. Foresight precedes advantage. Competitive edge begins with seeing what others hesitate to approach. Prometheus, seizing the flame, motion, urgency, and danger. The moment of irreversible action. The moment of commitment. There is always, sorry about that. There is always a point where leaders must act before certainty exists. Fire spreading across valleys, tools igniting, light expanding, civilization awakening. Tools change the game. AI transforms. It transforms strategy, product development, pricing, and decision velocity. It transforms everything. Fire, both building and burning, confusion, mixed outcomes, uncontrollable spread. Power without discipline is risk. AI amplifies both intelligence and mistakes. Prometheus bound to a rock, punished by the gods. Storm overhead, fire still burning below. Leadership does bear the cost. The risks are either ignoring AI or using it poorly, and leaders own the outcome. Fire harnessed, forging roads, cities, order emerging from the chaos. Mastery does create advantage. AI plus human wisdom, plus 12 ingredients I'm going to go into in a moment, equal competitive advantage. A wide horizon, civilization lit by controlled fire. Read controlled AI. Calm, power, enduring progress. Those who control the fire shape their future. AI is no longer experimental. It's strategic, required infrastructure. So, to summarize this myth, this tale of two organizations perhaps, to summarize, one company, fear, delays, progress burning. AI is not dangerous because it's powerful. AI is dangerous when leadership abdicates responsibility for it. Or the other. Focus wins. Progress will thrive, and AI plus human wisdom will equal advantage. Okay, that's my story. A little bit of fear and a lot of trepidation out there, but there's a lot of exciting opportunities. And we're going to sprinkle in and thread through our forecast, our look back, our segmentation analysis of the industry with AI. So this will be really exciting. Quick announcements. Tomorrow, we have a Breakfast and Bots event, and it's at 9:30, same time. It's going to be pretty exciting because we're going to go into deeper content than what you'll see this morning. So if you have, and it's an open discussion as well, so if you have a very specific question about AI or analytics or the industry, come see us. And then also we have a local event at UCI. Michael and I are professors in the Masters of Analytics program, and the Thursday before the Super Bowl, we do a Super Bowl predictive analytics event. If you're in town, come to UCI's Business School Auditorium. It's going to be fantastic. Okay. And again, just to reiterate and emphasize this morning's recurring theme, we do look at things with a left brain and a right brain. Even though we're economists and data scientists, AI experts, we do view that any successful analytical or AI endeavor encompasses both sides of the brain, left brain, right brain. So that's going to course through the presentation. If you don't know who we are, a raise of hands. Does anybody know who we are from the prior years? Few people, oh, maybe half, okay. So just a real quick, very quick 30-second drink the fire hydrant explanation. We're competitive analytics based out of Newport Beach. We pretty much cover now every type of analytic and AI engagement you can think of. We work in nearly every industry with Fortune 500 companies, as well as small companies and medium-sized companies representing every sector and industry. We do tend to do things exceedingly different. And as I mentioned, Michael and I teach at the UCI Masters of Analytics program. It's one of the most sought-after and popular business classes, analytic classes, I was told, in the United States, if not the world. And occasionally I go to Switzerland and teach as well. I've also been asked to teach an AI and new technology for leaders course, which might be available to the public at some point in 2026. Okay, let's now dig into the industry. Yes, they're looking forward to the macroeconomics too. All right. This is interesting. Should I continue or should I pause? I guess I should. All right, just keep on going. Can you hear me? All right, what the hell? All right, we'll do this with rhythm and some panache. All right. This is crazy. I've never had to deal with a marching band before. Okay, so ignoring that, we've got a lot of good news and a lot of bad news. Okay, I'm just going to be honest and candid about what's going on that drives your dealer success, your OEM success. There's a lot of external drivers out there. The first thing I'm going to go over is the TPSI, right? This stands for the 1,000-point Strength Index. And before I show you the live dashboard, I'm going to explain that it's an index of hundreds of thousands of drivers. Basically, 500 is your equilibrium point, okay? Anything above 500 is relative strength. Anything below 500 is relative weakness, okay? So let's take a look at where we are in the economy. This is a great exercise in concentration. I'm telling you, if I get through this, I'm going to give myself a pat on the back. Okay, so here is our TPSI. By the way, I will pay somebody $100 if they can go and stop those drummers. Okay, how about that? That would be real cash money. Okay, so we have data going back from 1792 to today. Okay, we're pretty insane about our data collection. And if you notice on the chart, you can see all the seasonality and cyclicality, economic cycles and business cycles through that whole period. But we're going to focus on just the last several cycles. So let me magnify this. All right. Yay. Now stop playing. That was very nice. Okay. So let's go to 1995-ish. There we go. Okay. You guys see that? Here's the last couple cycles. Now, the bad news is, given the overall holistic economy, you can see that the TPSI right now is 334. This is well below 500. Okay, the reward now is moving up to $250. Okay, I'm going to keep on raising it until I... Okay, thank you very much. Good job, though. All right. Love those bass drums. Okay, so, which maybe that might be a ritualistic calling for what's happening with the economy. So maybe this is archetypal. Okay, so the 334, you can see the deceleration in where it is right now. Now, don't panic and don't get depressed, because I'm going to show you some other equally countervailing positive drivers as well. However, this is a bit concerning because you can see here that we're at levels below this 15th percentile, that red line. That's low, and that beckons the possibility of a potential light landing recession. Okay, so that's one piece of the puzzle. I'm now going to talk about a new driver. We have a date where we're very data rich, we're data maniacs. We have a database of every public company, I believe, that's on a listed exchange in the world. 180,000 public companies. We took Polaris, Harley-Davidson, and 3 other powersport companies and took, because we have access to all their quarterlies, all their financials, stock indices, all that, and we decided to come up with a consolidated bunch of P&L items. And I'm going to show you that right now. So, we're looking at gross revenue totaled for those 5 companies, okay? And essentially, this is the good news. You can see that their financial performance in terms of gross revenue and sales has been rather good, right? They're about at an area where they're earning about $4.5 billion per quarter, and that trend is clearly up, okay? So for the macro, there are some troubling signs. But for this industry, it looks like you're maintaining a robust and moderately strong outlook. If we just look at a few other metrics like EBITDA, right, earnings before interest, taxes, and depreciation, which is basically net profit, you can see here that the trend is still upwards and probably bounding around, you know, $600 to $700 million per quarter in a positive fashion. If we look at expenses as a whole, that's a little concerning because you can see that big upshift over the last quarter. Looks like their spending is becoming quite robust. And if we just look at the operating income, you can see that's starting to taper down, right? Slight warning sign, but the overall trend is going up. Okay, so there's some granular analytics there. Okay, who here has heard about the K-shape economy? Raise of hands, right? That's kind of a new term. We have what's called the E-shape economy, and that's in our quarterly MIC report. But we also believe that the K-shape economy as a concept is valid, because what does K-shape mean? When you hear K-shape, it really means there's a bifurcation in the economy. There are a lot of good things happening and a lot of bad things happening. So there's a lot of literature out there. I tried to summarize it for you in about 30 seconds. Here we go. The upper part of the K, representing the good stuff, is higher income households are seeing incomes and wealth rise. AI data centers of construction is soaring. Stock markets are hovering near record highs. Consumer spending is still rising, incredulously. Productivity is still solid in terms of GDP. And on the lower side of the K, well, this is a little bit sobering. Hiring is sluggish. Home sales are weak. Wage growth slowing. Consumer confidence is weak. Unemployment rates ticking up. Factories are laying off workers. Inflation still persists. Affordability is still out of reach for lower and middle incomes. Okay, finishing up the macro, a lot of people are talking about the bubble, right? Is there an AI bubble? There is a tremendous amount, a voluminous amount of literature on this, right? Are we in a bubble or not? I could speak for hours and show you charts. I wanted to boil it down to one chart. It's not going to encompass all the nuances, but I think it gets the point across. What we're going to do is we're going to take the S&P 500's stocks and we're going to split it into the Magnificent Seven, which is NVIDIA, Amazon, Tesla. It's the 7 biggest tech companies, and we're going to carve that out of the S&P 500, and then we're going to look at the S&P 493, the other non-Magnificent Seven, okay? And we're going to look at the PE ratio. PE ratio is taking their stock price and dividing by their earnings. So it's kind of a gauge of, is the market too frothy? Is there a bubble? So just to give you a little perspective, the average PE for about the last 150 years is about 15-ish, right? And if we look at, say, 1990 on in a more modern era, it's about 20. 19 to 21 is a normal PE, no need to panic, no bubble. If you look at across the board all companies in a modern sense, a PE above 25 starts to get a little nutty, a little bubbly, if you will. Let's take a look at the 493. Pretty much aligns with the benchmark of a normal PE, right? So 493 companies in the S&P are kind of following, as an aggregate, a nice level, normal PE. Do you want to see the Magnificent Seven? That's the Magnificent Seven. Approaching 40. Now, there are reasons why this is maintaining, but we deal in gravity. We deal in data and analytics. And when you look at a long series of data, this is, as Michael would say, telling our clients, it is unsustainable. So we're going to be expecting a few minor, albeit minor pops during 2026. Okay, let's get back to look back and forecast. Not only that, we're going to take our forecast that we do every year for the last 20 years, and Lee, Christy, we are going to actually compare our forecast to an AI forecast. Takes a little bit of a humble approach to compare ourselves to a machine, but we're going to do that. And then we're going to talk a lot more about AI here in a moment when we bring Michael and Dominic up. Now, there's a lot of slides here. We're going to go over only 2. Again, we're going to maybe go a little bit more into detail on this later if you want to go find us. But here's the look back in the forecast for total motorcycle sales. You can see here the undulations between 2013 and 2024, and you can see last year, which is technically an estimate because we don't have the December numbers in finalized. You can see here that 2025 is going to finish moderately below 2024 sales figures. Our forecast for 2026 is coming in about stable. And I think that this can be looked at as good news because of the K-shaped economy, because of the aberrations and diversity of what's happening in the economy, and what's happening with what you saw at the P&L with those 5 companies, that the industry is, we call the industry for 2026 as remaining stable. And then after that, we see moderate increases from 27 to 29. Now, I'm going to skip some of the details here because of time, but we want to look at a look back in a forecast for new on-highway motorcycles. Again, same type of chart. We're just looking at on-highway. Again, you see the same general trend in the past, right? Upshift cycle, downshift cycle. But again, we see 2025 very much looking like the same for the total motorcycles, where we see a very slight downshift from 2024, and then a very, very stable continuation of 25 sales to 26 sales, with a slight uptick for the following 3 years after that. Again, I look at this as pretty good news. There have been AIMExpos where we've had a lot of nightmarish news, and we're bringing the wet towel to the event and saying that there's harbingers of all bad. But we look at this as the industry has a lot of potential. And by the way, we don't say that. We don't get paid to say that. We're brutally honest and candid about everything we do. But we do see this industry set up to maintain its relative strength. Okay. Now, let's take a look at our forecast that I just showed you with an AI-generated forecast. And again, I can't wait for Michael and especially Dominic to come up here and really give you more of the grist of the mill of AI. I just told you kind of a mythological story here, and now I'm going to show you a little bit of an output. We're going to get more deeply into it. So here is a long-term historical of total motorcycle sales and our forecast representing the black line. And then you got a red, blue, and green representing AI's forecast that we developed. I'm going to blow that up and magnify it because who cares about the history? Or all the history. Here's kind of what it looks like. So that's what we're saying for 2030, about 526,000 sales. Notice the upshift from 2025, okay, kind of going back to where we were at levels around 2023. Okay? Here is the first AI forecast. And again, there's going to be a lot of talk about coding and about how to prep it so it doesn't hallucinate, and we'll talk about that. I'm actually going to address that in a few moments. But the first one looked too conservative to us. The second model we ran looked a little better at 506. And then the third one, to us, it was probably a bit aggressive. But the takeaway here is that looking at these models in an ensemble format, meaning you take a look at different ways people forecast, and you've got a band. You've got probably a reasonable standard deviation of potential forecasts. Now, we're going to get into this a bit, but you can't just upload data, hit a button, and say, give me a forecast. So it's not as easy as it looks, not even close. But we're going to talk about that in a moment. And then here's kind of a full table history, probably hard to see there, but it just does show that the forecasts are all within the same ballpark, and that made us pretty happy. So I'm going to finish before Michael comes up by threading this AI piece into all the analytics we do for the power sport industry, and for that matter, all the other industries we're working on. There is a lot of talk. There's a lot of fear, trepidation, excitement, right? And I figure this is really, these next several slides, as I finish my portion, I just was adamant about talking about this. So here we go. Here is not just our AI journey, but I think this is relevant for all of you and anyone that is considering and should consider their AI journey. In terms of paradigm shifting technology, AI is today's magic, but it's not easy magic. And myriad everyday users of AI complain about grave errors, hallucinations, misleading falsities, and dangerous recommendations. We've experienced this ourselves. And they're not wrong. It could provide some very error-prone, misleading output. But our experience proves that fear, impatience, disbelief, and anger about AI may be more about culture and psychology than technology. We human beings are exponentially impatient, arrogant, polarized, and ignorant. Some people might get mad at me for saying that, but I'm a New Yorker. I tell it as I see it. But anything disruptive causes fear. So, analogy one about AI. You can't jump into a cockpit of an aircraft, hit a button, and fly from LA to Zurich. Yet. You can't just pick up a guitar and start playing like Eddie Van Halen. without lessons, study, music theory, and practicing for 10,000 hours. Yet. Last analogy. You can't just jump on a fancy Ducati and start racing competitively without experience and the time you need to put into it. What I'm saying is, AI is amazing if you put in the time first. AI does not offer immediate gratification out of the box. That's why now, when we hear people complaining about hallucinating, they're just uploading a question, and it comes back with crap. Well, of course. And we're gonna filter that out in a moment. And it can be dangerous, vastly misleading, right? And usually in the wrong hands it is. However, AI is boundless magic when it is coupled with the following 12 ingredients. Advanced data prep. You can't just ask it a question. You need to know the data involved. Advanced data visualization. Advanced analytics and economics. Subject matter expertise. Advanced English grammar and definitional skills are mandatory, like prompting. Advanced descriptive and explanatory skills. Deep computer and coding skills. Iterative scenario-based patience. Governance, ethics, human imagination and creativity, and of course, the most important piece, human wisdom. Now, to finish up, as an example leading up to this very conference and presentation, Dominic and Michael and Drew are our team here. We have access to a 19 million record database of every single motorcycle sold in the United States since 1998. We've got 20 years of experience analyzing for Honda, Yamaha, BRP, with all the analytics we do. And in terms of our initial prompts using AI for this conference and the stuff you're going to see momentarily, including those forecast models, Michael and I broke every single AI model we threw at it. It was horrible. It was ridiculous and humorous. ChatGPT 5.2, Gemini 3, Claude Sonnet 4.5. And we felt good about it. We're like, oh, good. AI won't replace our jobs. However, after applying patience and time and a vigorous dose of those ingredients, not only did the models produce accurate answers, but it startled us. It offered exceedingly insightful, creative, imaginative, and strategic thought. True magic, but only after persistence and hard work. Thank you. Michael?
Test. There we go. Thank you, David. All right. David did this screenshot for me. I'm a car fanatic, and I finally got a car with the doors that go up. You know, if you watch Silicon Valley, you'll get that reference. Before we get into AI, first, we're going to get into the data, right? Before you actually start using AI models, prompting AI, it's critical you understand the data, because garbage in, garbage out. You know, you can just drop a huge database into AI, ask questions, it'll give you answers, but you won't know if those answers are valid, if they're biased, if they're actually performing the analytics correctly, if they're including outliers, if it has cycles built in. So the first thing we do before using AI is visualize our data. That's the easiest and best way to really get a feel for what your data looks like, right? What kind of cycles, short-term, long-term cycles? Is it seasonal, right? Is that seasonality multiplicative or additive? Are there other outliers, or for example, like black swan events like COVID? You know, what effect does that have on your data? All these things need to be controlled for, right? So what we're looking at here, and let me get this into full screen mode, is motorcycle sales over time, right? And we can see right away this is very seasonal data, one. So we know that right away. And you can't just see that looking at a spreadsheet. It's really hard to see those movements by looking at an Excel spreadsheet or any sort of database. So we know now that it's seasonal. And not only that, we know by segment that seasonality varies. Yes, there are some commonalities between the segments, but there is a lot of variation in the peaks and troughs of each segment. Some peak in May, some peak in July, some trough in December, some trough in January. This is all important things to know about your data before, feeding into AI and prompting, because it's going to help with your prompting, right? When you ask AI, hey, do this or modify this, it's got to be based on what you know about the data and your subject matter expertise. Okay? So always start with visualizing the data. Now, what I'm going to do here, because say I want to build a long-term forecast, right? And I'm looking at this, and I can't really see trends here. So I'm just going to smooth this out. And we typically look at a lot of 12-month totals for motorcycle sales. So those are 12-month totals now. And now we can really see the trends, the long-term trends in the data, right? You see, obviously, the late 90s, early 2000s, huge sales. And then now back to normality. We see some COVID action in here, right? Some abnormalities, and then back to normalization. Now, this is one way of looking at the data, right? These are just aggregate numbers, right? We're just looking at trailing 12-month totals over time. Now, what this shows, though, is a lot of the times it's just a line going up. It doesn't really uncover a lot, right? So what we typically do with a lot of metrics, whether it's a metric like sales or an economic metric like GDP or job growth, is we look at the growth, right? And that's going to uncover cycles. So let me change this. Instead of looking at units, let's look at growth. Boom. Okay, so now we can actually see cycles, like the TPSI David showed earlier. We can see those economic cycles, right? We can see the troughs, right? Here's the financial crisis. We can see COVID, and the abnormalities there. And then we can really see, what segments are really strong. It may be low units, but we can see, look at the growth, even though it's decelerating, it's still growing. And then we see, a lot of the segments are actually negative growth. Okay? So once we play with the different calculations of our data, we can then start overlaying, say we want to generate a forecast. And we want to generate a forecast using macroeconomics that drive our sales, like job growth or GDP. Right? So now we're going to overlay data onto this to see what correlates with our data. It not only correlates, what causates, right? Because just because something correlates doesn't mean it actually drives your sales. So you gotta, again, use your subject matter expertise to filter out those indicators that may look like they correlate and drive your sales, but they don't actually do. So I'm gonna go to what we've developed here at Competitive Analytics. We call it autocorrelate. And what it does is download hundreds of thousands of indicators from the internet. Again, you can use AI to do that very easily. Just say, hey, download all this data from the Federal Reserve, and it'll download all that data. Overlay it with my data, join it by month. It'll do it automatically. But again, you have to know the data to be able to do this. So here we're looking at on-highway sales. That's the blue or turquoise line. That's the growth. The growth, year-over-year percentage growth. And the black line is the economic indicator we're looking at. Right? In this case, we're looking at real gross domestic product per capita, which is a proxy for income. And that makes sense, right? Income goes up, sales go up. Jobs go up, sales go up. Right? And that makes intuitive sense too. Like, it's not just something that correlates, this is something that causates. Right? But we're not only looking, and then down below we have a bunch of different metrics. So I can actually click through all sorts of metrics and visually see, not just rely on the math, what correlates and what makes sense. Right? But let me get back to real gross domestic product per capita. So we're not only looking for metrics that lead, though, or that correlate, we're looking for metrics that lead. So what happens 8 months ago in our GDP, our income, affects our sales today. Right? Makes sense. People get jobs. People make income. People have disposable income. People buy our things. And in this case, it's an 8-month lead. Right? And you can see like the trough here, April 2019, the trough in sales around Feb 2010. And I'll visually display this. I actually built in a parameter that allows us to see this in action. So I'll start clicking this black line over 8 months, and you'll see it start to lock in. You see the correlation here. Now the trough lines up. Ignore COVID. That was an anomaly where sales actually spiked where everything else was going down. And then again, now it's back to normality. So what we're doing is isolating the indicators that lead ours. And in fact, we don't even need to generate a forecast now. We have an 8-month forecast built in because I already know what's happening with income. So I know what's happening with income today is going to affect our sales 8 months from now. Now, to take it a step further, what we do is do this for thousands of indicators, find the best bundle of metrics, of indicators, that drive our sales, right? And a lot of the models we build, it's like 5 or 6, right? We don't want to have too many, because then it gets convoluted, and you start overfitting, and it's a whole, mathematical mess. Right? And we use several methodologies in-house to be able to isolate the bundles that generate the best overall forecast. Right? I'll show that here. So here are 6 metrics across the top that we're using to generate a forecast for all motorcycle sales. Okay? We have median month supply, total debt held by the public, personal consumer expenditures, the exchange rate, non-farm employment, and real GDP. The green indicates that it's a positive metric or a positive corollary, and the red indicates negative. So when employment goes up, sales go up. When debt goes up, sales go down, right? So inverse versus positive correlation. Down below, we have, again, the actual sales in the turquoise, and then we have the model in gray, right? So with these 6 economic indicators, they derive or extrapolate that gray line, which is about a 95% R squared, which means it can explain, these 6 indicators can explain 95% of the movement in actual sales, which is pretty amazing. So it's very accurate. And then from there, what we can do is we generate a forecast for those economic indicators to get our forecast for our sales. And then we can also conduct stress tests right away. So I can come up to real GDP and say, okay, what if in year 2 it's going to be 10%? And whoa, okay, our forecast jumps up quite a bit, right? So we can, on the fly, in minutes, generate stress tests. What's our best case scenario? What's our worst case scenario for the next few years? Now, there are variances in the gray line versus the blue line, right? And you'll never be able to explain 100% of the movement in whatever you're trying to forecast. It's just not, it's not possible. But one metric we're missing here, a big one, is an internal metric, and that's price. So what you charge for a product is obviously going to affect the volume you sell, right? That's price elasticity. So that's what we're going to get into next. So let's take a look at some prices over time. Okay. So this is a price index chart. I don't have permission to show you actual prices, or the manufacturers. So you see the manufacturer, this is a manufacturer code, which has been anonymized. And then the index is just index based on the start date I choose to 100, and then it'll grow from there, right? I'm going to shrink this data set up, though, just to focus on like the last 15 years. So let me, close enough. Okay. So if I'm looking at this from, say, February of 2010, on average, motorcycle sales have gone up about almost 18%, right? And a lot of that due to inflation. But you can see the drastic differences by manufacturer. It's huge. However, this is not just, and the lines may appear volatile too, right? But it's not necessarily volatility. This is strategy. Right? And your strategy depends on the manufacturer and the product you're selling too. And I'll get into that in a little bit. Now let's focus just for a second on highway. And I could do this by general type, specific type. If you're interested in seeing more of these charts, come see me after. We can schedule an appointment. Let me just take a look at on highway. On highway, okay, there's the average 11%. So we're lower average than total market, but a wider range too, from negative 34% all the way up to 60, almost 60%. So lower average, but higher risk, higher volatility in that segment. And what this emphasizes, too, is the different pricing strategies that each of these manufacturers have. So when you're generating, say, a price elasticity analysis of how do my increases or decrease in price affect my customers buying my product, it's very important you do it by manufacturer, not just using, say, industry data. Right? It's also important that you do it by the specific model type and even CC categories. So I'm going to reinforce this. Let's get into, I have the same index, but with sales. So there's a sales index, and I'm going to highlight, just for example, manufacturer 1 on this one. I'll go back to the price index. Manufacturer 1. See those inverse? Right? That makes sense. Raise your price, sales go down. Lower your price, sales go up. So that's just to drive home the elasticity of demand. And you can see here with the sales index, the COVID rise, right? And a lot of manufacturers during this period were also raising their prices. And COVID was an anomaly, shift in preferences, supply shortages, which allowed manufacturers to do that, sell more at a higher price. Now that doesn't make economic sense in the long term. Right? So when you're generating, say you want to generate a price elasticity analysis, you have to understand that you can't use this data in that analysis. You have to take that out. You want to look at, say, only post-COVID data when I run that analysis. Otherwise, you'll get funky results. Again, you feed this all into AI, I'll give you these results. You have to filter that stuff yourself. I also have, a revenue chart, a model count chart. Again, if you're interested in seeing these, come see me afterwards. I also have a price distribution chart, which is pretty cool. So what this shows is the unit sales by price bin. So you can see the 8,000 to 10,000 bin is where a majority of the sales are. And I'll in fact expand this date back even more, and you can see that even further. Now, what I have here, and I can't show, if you work for one of these manufacturers and you need to see what percentage share you make up of each of these bins, come see me after, I can show you. I also have a displacement distribution too, so if you want to see how much you make up certain displacement bins, I can show you that as well. I also have this by state, so if you want to see what sales you have, percentage share by state, I can show you that. And if you want to see it by county, we can show you that, or zip as well, I can show you that. But you have to work for one of these manufacturers and you have to come see me after. Lastly, in this chart, I just want to drive this home. I know you can't make this out because the data table up top, I can't show you these numbers. But I do want to show this, what this chart is. This chart below here is called a bump chart. And it shows over time the ranking of these categories, where they lie as far as total sales among the other categories. So for example, cruiser dominated the market, ranked number 1 for a long time. You can see now it's set 2, and it's fall from grace all the way down to 6. Whereas sport bike, boom, number 2 now, right? Pretty amazing. And I want to drive home, in expanding markets like sports bike, when you raise prices, people are less sensitive to price increases. So it's, again, good to know that. Whereas like segments like cruiser, you raise the price, people are going to be a lot more sensitive. That's way more elastic. So we've got to be aware of the trends in our markets as well. So let's get to, finally, price elasticity. So this is a scatter chart of a very particular segment within a particular CC range. And the color represents the different manufacturers. And so we have MSRP on the vertical axis and sales on the horizontal axis. And Overwhelmingly, you see these curves, right? These are the trend lines. These are demand curves, right? The lower the price, the more you sell, and opposite, right? But you can see how they vary by manufacturer. And this is for a very particular segment with a particular CC range. And you still see them all over the place. Again, drive home the fact that you have to do these analyses at very toned down sections of the data. We also see some are really steep and some are really flat. Again, some manufacturers can raise their prices without the customer actually decreasing their sales that much, whereas some manufacturers have the opposite effect. Right? Now let's look at the actual demand curve. So what we're going to do, we take this curve, see that equation there? Don't worry, I'm not going to get into that. But that's a log equation. So we're going to take that equation and we're going to build a demand curve. Okay, so here we have, again, for a particular segment, I can't show you, this is segment 1. Right? We have the average MSRP, and then we have the monthly sales. So at an MSRP of $4,867, they can expect to sell about 1,223 units. Over here on the right, I don't know if you can see this, we have your MSRP, and you see this negative 2.75. What's that mean? That's your elasticity of demand. If you raise your price by 1%, your sales will go down negative 2.75%. That's what that says. And I got that from that logarithmic function. Right? Competitor MSRP, what's that mean? 1.35. That means if your competitor raises their price by 1%, your sales will go up by 1.35%. Right? So that's competitive elasticity of demand. So let's see this in action. So I have some parameters here that allow me to raise my price. Say I want to raise my price 10% or 5%. And watch the demand curve. Oh, so the dot just shifted up. So my MSRP went up by 5%, and my sales went down by 12.86%. Let me zero this back out. Now, what happens when my competitor raises their price 10%? Oh, the dot didn't move per se. The demand curve shifted to the right. That's what happens when your competitors start raising their price. People substitute. They come to your product, which shifts your demand curve over. Okay? Now, what this comes in handy for is, I'm going to zero these both back out, is tariffs. So what if everyone has to raise their price 15%, right? So I'm going to go 15 on my price, negative 33, 33% down in sales, ouch. But what if my competitors also raise their price 15%? Now I'm only down 20%. So everyone comes down too. Now, we've been doing these sort of analyses for a long time for several industries, from pharmaceuticals, grocery stores. I could tell you, what to price a 12-pack of Bud Light at to, optimize profit. We've even done it for hotels, and again, powersports, automobiles, everything. So this was one of the problems, because I work on a lot of these price elasticity analysis. I wanted to throw AI, right? I threw it, the MIC database and said, hey, give me price elasticity for 2 main segments, right? And let's take a look at what it said. So what it did is it generated a price elasticity for traditional segment and the trail other. And we can see traditional segment, this is that price elasticity coefficient again. It generated this on its own. I didn't tell it to do it at all. And it did the whole methodology, how I would go about it. It did it pretty accurately. Elasticity, negative 3.64, which indicates a 1% increase in price could theoretically lead to negative 3.6% in volume. Right? However, the model fit is very poor. Right? So what it then says is other variables are affecting this, right? Like brand, style, location. And like I highlighted earlier, macroeconomic factors. Right? Price can't explain everything. That's why those lines, all those dots are all over the place. They don't quite fit with just price. There's a lot of other factors going into that. Right? So it actually makes some recommendations on what to do next. Trail other. This one has a positive elasticity. Now that doesn't make any sense. You can't raise your price and expect more sales. That's because it's using maybe outlier data from COVID, right, to generate the results. So again, know your data before you just dump it into AI. Okay? And what it says, that this one actually has a pretty high R-squared. But when you see results like this, what you have to do is then continue prompting. I need to do more prompts. I need to filter the data. Only look for post-COVID. Incorporate RGDP into the forecast, yada, yada, yada. So what I'm going to do now is I'm going to turn it over to Dominic, and he's going to get into how to correctly prompt AI.
All right. Thank you, Michael. So I am the AI guy on the team. I brought a little humanity with me. I took this photo in Vietnam, actually. So it's not AI generated, trust me. But what I want to do is take a step back to talk a little bit about the mindset of how we approach the utilization of AI in this work, and then show you what these components are that lead to the quality outputs that we're able to get from it. So when we are thinking about how we are incorporating AI into our workflow, whether it is the work that we're doing in competitive analytics or whether it's the work that you are doing in your organization, you need to be thinking about a spectrum of use, okay? Because there is not just one magical way in which we can apply AI and get the answers that we want. That's something you keep hearing from us over and over in this presentation. One thing I like to highlight is this idea of a spectrum of use. For any given task, for any different method by which we're trying to derive value, we can think about the ways in which we apply AI. So let's think about the use case of data analytics. Okay, we are trying to derive value and understanding from our data to drive the decisions that we make. What does this look like if we bring AI in a very minimal way? That's low AI use. And then what does it look like as we move up that spectrum to provide more autonomy to the system? Well, starting on the low use, we're talking about something like data prep and cleaning. Okay, something that we've been hitting on over and over is that you need quality data to go into these kinds of calculations. And this is where AI can be immensely helpful. It can take your data and ensure it's meeting the right format, meeting the right parameters for you to be able to do the calculations that you need. You are still doing the work in a traditional manner. You're not changing the way that you've done things, but you have this tool to help you get to where you want to be. That's a very minimal use of the technology. If we move up the spectrum just a little bit, now we can invite AI to provide some critique of our insights. Again, you are doing data analysis in the way you've always done it, but now you are going to invite AI to provide a second opinion. It's going to let you know what it thinks of the work that you did and give you suggestions on, are there any gaps in your understanding? Is there any bias that you may need to correct for? Ultimately, you are still the decision maker, but now you have this additional insight. If we go even further, AI exploratory analysis. So now we invite AI to look at the raw data from the very beginning. It's going to extract out its insights. It is there as a co-intelligence to help you suss out the information you want while you are still applying your wisdom in how to make the best use out of it. We go even further, now we're in the realm of AI predictive modeling, where not only is it looking at the historical data, but it is making predictions on where we go from here to help drive your business decisions. You are still in the driver's seat, you are still making those decisions, but that tool is there augmenting what you decide to take action on. Going all the way into the high AI use realm of AI automated execution. Not only are the tools autonomously analyzing the data, but now they are executing business decisions on your behalf with minimal human oversight. That sounds rather scary. You're not going to get to this part of the spectrum until you have done exhaustive testing. And it's not going to be applicable for any task. It's really important to highlight that none of these are inherently good or inherently bad. It all depends upon your organization, your data, and what tasks you are choosing to invite this technology in to augment the work that you do. Ultimately, you have to make that decision. But as you do, you will discover that different tasks, different ways of looking at your data are going to fall on different parts of this spectrum. Data and design are what make AI magic possible. And in terms of how we approach this, I want to talk about these components that we utilize in order to get the results that Michael had touched on earlier. And I'm going to be running a demonstration for you live right now of what this ends up looking like. So in terms of how we make this all possible, first and foremost is the model. AI models are seeing surges in capability. This big boom in AI started with OpenAI's debut of ChatGPT in 2022, but since then, we have had multiple players release incredible models that are proving incredible exponential improvements in capability, and that's opening up new opportunities. This is why this is a conversation that we all have to be in. You can't afford to sit out. You can't afford to have your head in the sand. Okay? The AI models are improving, so new opportunities are presenting themselves. But they are just one component of what derives value. What else do we need? Well, prompting. We keep bringing up that term, prompting. Essentially, the instructions that you are giving so as to make sure the model is doing the thing that you want it to do. You have to articulate clearly what it is you're trying to get out of it. And it is as much an art as it is a science. This is where it can be quite a struggle for some folks to wrap their heads around it. But explicit guidance requires expertise in order to know what questions you want to ask of these systems. So we need these two components. Third one, context management. In other words, the data and the knowledge that you give to the system. Now, these AI models on their own are already quite knowledgeable. You can go to an AI model, it could be connected to the web, or it could just be based off its own training data. Either way, they already are very capable and they know a lot. But when we talk about hallucinations, when we talk about the AI fabricating information, typically this is the result of you not giving it the data that it needs. Okay? Clean, organized data yields accurate outputs. And it's not a matter of dumping all of your data into an AI system and expecting it to do magic for you. Too much data, you drown the system. It can't give you anything that useful. Too little data, you starve it. The outputs are going to be generic. The outputs are not going to be aligned to your organization. So we need the context, and then the last component of it is tool orchestration. With tool orchestration, now we can connect in software that allows the system to execute tasks on your behalf. It's able to do more than just generate content. It's able to write code. It's able to create its own software in order to solve the problem that you gave it. It's really quite remarkable now what these systems can do. When you give it the problem, and it's not just crunching data and acting as a calculator and autocomplete, it's actually going off and writing its own software to solve your problem, which is honestly remarkable. Now, I want to show you an example of our AI system doing this work. And so we're going to look at the use case of optimizing market coverage. Okay? And the way this is going to work, here is the prompt. Well, this is a condensed version of the prompt that we're going to give it, but we're going to tell it to access the Motor Industry Council sales database at your disposal and perform the following. Assess whether dealer presence aligns with demand potential at the county level, so state and county level. We're going to look at data aggregation and modeling, so aggregate all demographic and registration data to the county level using gravity models, that's population times income, to rank markets by unmet demand. We're We're going to look at gap analysis, so compare current registrations per dealer against demographic potential to identify white space counties that exhibit high demand indicators but low dealer coverage. And then finally, specific outputs. Deliver actionable recommendations for network changes, specifically ranking the top 10 urban and top 10 suburban counties with the highest unmet demand. That's a tall order, but we're going to have AI take a swing at answering it. Now, in order to avoid tempting fate, I have a recording of the AI responding to this question. Now, I'm going to tell you right now, you're going to see a whole bunch of stuff go across the screen, and it's going to be hard for you to keep up. You don't have to try to keep up. I'll provide some commentary, but let's just watch. It'll be a little over a minute of this AI going to work responding to this question. So first I put the prompt in. And initially what it does is it accesses the database and our data dictionary. Our data dictionary is providing reference material, letting it know how the database is organized. It then goes and writes Python to do a SQL query. So it's querying the database, pulling out that data to ensure it's able to do so reliably. Okay? Once it's successful, it makes a plan of action. You can actually watch its internal monologue as it's thinking about how it's going to go about doing this work. So it writes the commands, and it goes and generates the outputs. Really interesting is as you watch it work, if I were to pause it at certain moments, you can see it's actually making mistakes. But when it makes a mistake, it takes a look at why that mistake happened, and it goes back and it fixes its work. Okay? So then, as we go through, in fact, it went so fast it's already done. One of the things that was really interesting about this, okay, here it comes out with the results. We noticed when we ran this initially, it had a bit of an East Coast bias. It was giving us a lot of results out on the East Coast. And so what we ended up doing was iterating upon that and saying, okay, give me county, state, top 10 suburban, urban areas, but divvy it up. So that we're looking at east of the Mississippi, Mississippi to the Rockies, and the West Coast. And it was able to go and actually give us those. David's going to show you those outputs in just a moment so you can see, instead of trying to watch that video screen by, he's going to actually show you the results from that. But the AI was able to give us phenomenal results. And what you just saw was as the user of our AI system, developed my prompt. My prompt is based upon the subject matter expertise that I have for the industry and my understanding of the AI's capability. I feed that in, and the system is going to be using those 4 components that I just mentioned. In our case, we utilize Google's Gemini 3 as the AI model to do this work. We have an established the system prompt is an established process for data analysis tasks. The context is going to be those data sources I mentioned, the SQL database and the data dictionary, which provides reference to that SQL database. And then tools. It was able to write its own Python code in order to make queries to the database all on its own. I didn't have to do that. I'm not very good with Python, but I don't need to be. The AI system does that for me. And through those components, it gives me the response, which I can then take and iterate upon. These are what make the magic of AI possible. Now, I'm going to hand it off to David to talk a little bit about the results that we got from that particular use case.
Thank you. Awesome job. Awesome. Okay. We technically have 10 minutes, although I think we get a premium bonus for the marching band disturbance. So I'll take maybe an extra 5 minutes. I'm going to show you some results of the AI bot we ran that essentially is going to provide this task of dealer presence aligning with demand potential. Okay, so this is right contextual to your interest. Okay, I'm going to go through a couple of tables really quickly. We really want to get to Q&A, so if you want to dive into these charts, just look at us, go see us after the presentation or tomorrow at breakfast in Bots. But we divided the United States into 3 divisions: East Coast, Mid and West Coast. And it really shows the sales gap really densifying in New York City and Chicago. Texas was a large identifier of AI, of underpenetrated markets by dealers still. And then in West Coast, there were some other high-income coastal counties in California that were still being underserved. Again, I'm going to kind of just throw these here and just show you these tables really quickly so we can get to some Q&A because we really want to field some questions. Again, AI literally came up with these criteria, formulae, and calculations. Again, the magic. So if we just look at the East Coast, east of the Mississippi, if we look at urban markets, urban target markets that dealers could look at as being underserved, meaning net demand potential, you can see here Cook County, Illinois, Kings, New York, okay, so forth and so on. I'm not going to go through some of these numbers because it's hard to see, but you have a top 10. AI and our prompting and our data analytics have developed top 10 targets, potential market targets for dealers for underserved county markets. We have some for suburban markets east of the Mississippi, and then we looked at the Midwest, Mississippi to the Rockies. Again, we have urban targets like Harris, Texas, Dallas, Texas, Travis, Texas, and then we have suburban markets, which I think were defined by AI as population centers below 750,000. So here are suburban target markets underserved by dealers. And then, of course, we have the West Coast, LA, Santa Clara, Alameda, King, and if we look at the suburban markets. So with that, thank you, and let's take a look at some Q&A from the audience. Do we have a microphone that we could provide anybody? And hey, do not be bashful. Any question is a possibility. And so we still have some time. Does anybody have any questions about the market? There we go, first question. I'm going to grab one of these because...
All right, so you're...
Testing, 1, 2.
No, man, this is loud.
Testing.
All right. You mentioned that those are the markets that are underserved. Do you believe that's because of a lack of dealer presence or a lack of dealer performance?
No, it's not about performance, and it's not probably so much about presence. The question is really what was brought to AI is we loaded up with population, demographics, the full 19 million record database I referenced, right? And a lot of prompting and a lot of those ingredients we mentioned. Because again, when we asked that question, by the way, initially, it came out with absolute garbage. But after some care, what it did is it came up with gravity models, and it decided on its own, after some very granular prompts, to say, hey, based on population and a lot of other factors, and your actual sales for all those suburban and urban areas, what it did was it said, look, given the whole picture of the United States and how dealers are performing as a whole, think of it as TPSI 500, which are the ones that are actually have opportunity? So AI actually pointed out and said, hey, that county, based on population, drivers, and such, you're only selling here, but AI is saying you have a potential to sell here. And it did that for every single county, 3,140, I believe, right? Bifurcated by division and by population. We could do that, yes. We didn't do that for, yes, okay, so the dealer locations were implied and interpolated, but if you wanted to get into, hey, this is an exact dealership on Smith and First Avenue, right? We've got the data to get down to the tract level. The tract level is like an area that's a couple of city blocks. And then what we use is drive time analytics to say, look, I mean, we don't have that right now. We can do this, and then our next step is to have AI do this. Hey, dealer XYZ in this block, given a 10-mile or a 20-minute drive time at rush hour, give me the gravity model. Give me if it's underserved or not. What's the potential sales above what I'm doing now? That's magic. That's power. So the answer is yes, it can do that. We don't have that for you right now, but we can do it because we've done it with many different industries. Great question. Thank you. Anybody else?
To follow on that, what you're just saying, so let's say my dealership, I want to come to you. Is that something we can do as a fee-based? We can say to you, I love this presentation, but I want to apply it to my own. How does that work?
Yeah, so first of all, if we could give you tips to do it yourself, we're happy to do that too, right? Because we're very fortunate that we're very busy, right? And we've got a lot of great clients. But we also can tell, those warnings and all the paradigm shifts. We would probably see what kind of data you have and figure out a plan, whether you do it yourself or maybe there's a little bit of support we can provide as an advisor or build like we do for companies like Toyota or Honda, a full-blown analytics AI infrastructure. But the bottom line is, what do you need? Your needs are going to be different than, this dealer or this dealer. So we figure that out first, right? We figure out all of that to provide. And then the first thing we do, by the way, is we don't build the whole mechanism because that never works. And a lot of consultants want to do that. We build a little teeny concept, a proof of concept, and we get one thing that works. Then we magnify it. So whatever your goal is, we'll take a microcosm of it and build a win out of that. Because as you saw, and I'm telling you, when we ran our first couple of models and asked it to, hey, derive some elasticity, AI, it came up with such laughable, horrid stuff. But again, we got it to work. So there is a secret to the magic, and we can show you how that will happen. Like Dominic and Michael and I talked about, clean data and all those other ingredients. But absolutely, we're happy to talk to you about how to build your AI infrastructure. Yes, and by the way, you can tell how enthused we are about AI because it's doing things we could not imagine. Anything else? Any other questions? One more question? Anything? Macro, micro? Nothing? All right. Oh, there we go. No more marching bands, so I'm very excited about that. Could you imagine if there was trumpets and trombones? That would have been more challenging to overcome.
I'm just curious, the role of the large language models that you're using, with all the prompting and the back and forth, do you really find it to be easier than just throwing the data into Tableau and defining your dimensions and measures and analyzing it that way? It sounds like you have to go back and forth quite a bit.
Yes, okay, let me address this because we dealt with this. So we're proud that we have the analytics, the deep analytics we've been doing for 15, 20 years, right? So the first thing we did is we said Dominic and Drew, the AI guys, they would develop answers in the beginning, and we would go back, and Michael would go into those dashboards he was going through that you probably couldn't see, and AI says that the amount of sales in this zip code, 92603, is 48. And Michael would be like, no, that's not right. So we would go back and forth and start connecting and syncing the AI with the actual data. We didn't really talk about that too much, but there is sort of a testing and auditing piece that has to go back. And so we do that. And I would say, just to summarize, there are certain tasks that are still more efficient with data, Tableau, advanced analytics than running AI. That said, though, everything we did today and that we've been doing, once you have the database all clean and all those ingredients are worked out, asking it a very scientifically well descriptive prompt and having AI provide more feedback is phenomenal. So there's a give and take. We look at it just another tool now that we can use to expand the insights for businesses. Where it's going, like that slide said in the Prometheus story, it's here. It's not experimental anymore. It's only experimental when you're just throwing random questions at ChatGPT and thinking, well, I didn't really prompt it well, and I'm not using clean data and all those other ingredients. So it's both. Are we, one more question, or are we donezo? Okay, last chance. We're gonna be available off to the side, but I just wanna say on behalf of Michael and Dominic, we thank you for your attention. We really enjoy being here every year, and thanks to the MIC staff, and we'll see you either later or next year. Thank you very much, and come to the Breakfast and Bots tomorrow.